We are here with a very important video regarding the investments you can make in 2020. Now, 2020 has been a very cruel year in many ways. Do I even have to mention the global pandemic ravaging the world? It has destroyed families and businesses, but not all is lost. We still believe there are possibilities to make good out of it financially. One of the best ways to secure your financial future is to invest. And one of the best ways to invest is over the long term. With the first half of 2020 being so volatile, it's more important than ever now to focus on investing long term. People think of investing as trying to make a short-term score in the stock market. In reality, though, investing is a long-term process where regular investors can really build wealth. By thinking and investing long-term, you can meet your financial goals and increase your financial security. Investors today have many ways to invest their money and can choose the level of risk they're willing to take to meet their needs. You can opt for very safe options such as a certificate of deposit, also known as a CD, or dial up the risk and the potential return with investments such as stocks and stock mutual funds or ETFs. Or you can do a little bit of everything, like diversifying so that you have a portfolio that tends to do well in almost any investment environment. While long-term investing can be your path to a secure future, you'll want to understand the importance of risk and time horizon in achieving your financial dreams. To get a higher return while investing, you generally have to take on more risks. So very safe investments such as CDs tend to have low yields. Medium risk assets, however, such as bonds, have somewhat higher yields, and high risk stocks have even higher returns. Investors who want to generate a higher return will need to take on higher risk. It's as simple as that. While stocks as a whole have a strong record, the Standard & Poor's 500 index has returned 10% over long periods. Stocks are well known for their volatility. It is not usual for a stock to gyrate 50% within a single year, either up or down. Can you withstand a higher level of risk to get a higher return? It's crucial to know your risk tolerance and whether you'll panic when your investments fall. At all costs, you want to avoid selling an investment when it's down if it still has the potential to rise. It can be demoralizing to sell an investment only to watch it continue to rise even higher. Here are the best investments keeping in mind the current situation. In the world of stock investing, growth stocks are the Ferraris. They promise high growth and along with it, high investment returns. Growth stocks are often tech companies, but they don't have to be. They generally plow all their profits back into the business, so they rarely pay out a dividend, at least not until their growth slows. Growth stocks can be risky because often investors will pay a lot for the stock relative to the company's earnings. So, when a bear market or a recession arrives, these stocks can lose a lot of value very quickly. It's like their sudden popularity disappears in an instant. However, growth stocks have been some of the best performers over time. If you're going to buy individual growth stocks, you'll want to analyze the company carefully, and that can take a lot of time. And because of the volatility in growth stocks, you'll want to have a high risk tolerance or commit to holding the stocks for at least 3 to 5 years. But where there is fruit, there is risk too. Growth stocks are among the riskier segments of the market because investors are willing to pay a lot for them. So when tough times arrive, these stocks can plummet. That said, the world's biggest companies, the Facebooks, the Alphabets, the Amazons of the world, have been high growth companies, so the reward is potentially limitless if you can find the right company, that is. If you're not quite up for spending the time and effort analyzing individual stocks, then a stock fund, either an ETF or a mutual fund, can be a great option. If you buy a broadly diversified fund, such as an S&P 500 index fund or a NASDAQ 100 index fund, you're going to get many high growth stocks as well as many others. but you'll have a diversified and safer set of companies than if you own just a few individual stocks. A stock fund is an excellent choice for an investor who wants to be more aggressive but doesn't have the time or desire to make investing a full-time hobby. And by buying a stock fund, you'll get the weighted average return of all the companies in the fund. So the fund will generally be less volatile than if you had held just a few stocks. If you buy a fund that's not broadly diversified, for example, a fund based on one industry, be aware that your fund will be less diversified than one based on a broad index, such as the S&P 500. So if you purchased a fund based on the automotive industry, it may have a lot of exposure to oil prices. If oil prices rise, then it's likely that many of the stocks in the fund could take a hit. Therefore, a stock fund is less risky than buying individual positions and less work too. But it can still move quite a bit in any given year, perhaps losing as much as 30% or even gaining 30% in some of its more extreme years. That said, a stock fund is going to be less work to own and follow than individual stocks, but because you own more companies. And not all of them are going to excel in any given year. Your returns should be more stable. With a stock fund, you'll also have plenty of potential upside. Here are some of the best index funds. A bond fund, either as a mutual fund or ETF, contains numerous bonds, often from a variety of issuers. Bond funds are typically categorized by the type of bond in the fund, the bond's duration, its riskiness, the issuer, and other factors. So if you are looking for a bond fund, there's a variety of fund choices to meet your needs. When a company or government issues a bond, it agrees to pay the bond's owner a set amount of interest annually. At the end of the bond's term, the issuer repays the principal amount of the bond and the bond is redeemed. A bond can be one of the safer investments, becoming even safer as part of a fund. Because a fund might own hundreds of bond types across many different issuers, it diversifies its holdings and lessens the impact on the portfolio of any one bond defaulting. While bonds can fluctuate, a bond fund will remain relatively stable, though it may move in response to movements in the prevailing interest rate. Bonds are considered relatively safe relative to stocks, but not all issuers are the same. The return on a bond or bond fund is typically much less than it would be on a stock fund, perhaps 4 to 5% annually, but less on government bonds. It's also much less risky. They say real estate is a business for all trades. It takes a good bit of money to get started, the commissions are quite high, and the returns often come from holding an asset for a long time and rarely over just a few years. Still, real estate is the favorite investment by Americans according to a 2019 Bankrate study. Real estate can be an attractive investment in part because you can borrow the bank's money for most of the investment and then pay it back over time. That's especially popular as interest rates sit near attractive lows. For those who want to be their own boss, owning a property gives them that opportunity. And there are numerous tax laws that benefit owners of property especially. With that being said, while real estate is often considered a passive investment, you may have to do quite a bit of active management if you are renting the property. Anytime you're borrowing significant amounts of money, you are putting extra stress on an investment turning out well. But even if you buy real estate with all cash, you'll have a lot of money tied up in one asset. And that lack of diversification can create problems if something happens to that particular asset. And even if you don't have a tenant for the property, you'll need to keep paying the mortgage and other maintenance costs out of your own pocket. While the risks can be high, the rewards can be quite high as well. If you've selected a good property and manage it well, You can earn many times your investment if you're willing to hold the asset over time. And if you pay off the mortgage on a property, you can enjoy greater stability and cash flow, which makes rental property an attractive option for older investors. An IRA CD is a good option if you are risk-averse and want a guaranteed income without any chance of loss. Like the name says, this investment is just a CD inside an IRA. And inside a tax-friendly IRA, you'll avoid taxes on the interest you accrue, as long as you stick to the plan's rules. Even if you don't get a CD within your IRA, it is nonetheless a very smart investing decision. Also, the risk on an IRA CD might not be quite where you expect it. You have almost no risk at all of not receiving your payout and your principal when the CD matures. It's about as safe an investment as exists, and the FDIC can guarantee your account at any individual insured institution up to $250,000 per depositor. The real risk on an IRA CD is whether you're earning enough to beat inflation. It is one reason that if you have a poor CD portfolio, a great strategy actually adds some risk to get a much better long-term return, especially if you have a long time until you need the money. Thank you for watching the video. If you have any queries or need any guidance, don't hesitate to post it in the comment section. Don't forget to subscribe to our channel and click the bell icon. We have other helpful and interesting videos as well, so be sure to check them out.